So I've just dropped 3 companies and added 2 more. Now I know I've chopped and changed a little bit, but these are pretty big names, but ultimately not cutting it for my dividend strategy. Today I'm going to break down why I've dropped them and why I've added 2 different types of stocks to my portfolio. But this does actually move my goal to 1 million in my dividend portfolio a lot closer, and also the passive income side a lot faster. Let me explain. Now I know I probably have to redo my opening video here. It did very well in terms of performance, but a lot of those stocks have now changed. I've listened to so many comments and I've answered so many questions, and a lot of it does make sense. And I've added obviously ETFs, but I'm using a new platform that gives me a lot better data, more information in terms of stock rating. And it just makes logical sense. Why would I want to put my money into a dividend stock that could actually be not doing very well in the short term? I want something a bit better. So let's go into it. By the way, if you're new around here, please do subscribe and leave a like and comment as well what you think. And also comment if you agree or disagree. So I'm using a new platform called Stockopedia. There's a link below to this. Is a free trial. Feel free to jump in. There is a 25% off discount using my link below. So if you want to try it out, give it a go. I've removed Shell first and foremost, right? And it's not terrible stock, but top right hand corner, you can see the stock index isn't really fulfilling my goal. Now, my portfolio is based off a certain metric, and I'll reveal that later on when I go to the portfolio on here. And I've talked about it in my opening videos about my dividend portfolio, what it wants to represent. There's 3 core elements, right? But let's talk about the obvious in the room. This is not doing very well in the short term. Yeah, you can argue it's a big cap and all that kind of stuff, but it has had a few little issues with certain things. And let me go through, obviously, the EPS, for example. That isn't doing great right now. But we can also talk about the dividends. The dividends also, you could argue, sluggish. And there's also situations around the fixed assets. So there's issues there where you're thinking, short term. Not to mention, in terms of the financial brief here, a bit of a decrease. 8% in terms of revenue, which is a bit of an issue. You've got a 23% decrease in common stockholders' stock, essentially net income and stuff like that. So that's a problem. You've also got a lot of issues between barrels and conflict. There's a lot of stuff here to unpack. And share profit of joint ventures decreased 40%, 1.33 billion income. So it hasn't taken a huge hit in my portfolio kind of value, but I look at that and I think, yeah, it's a bit of an issue. Also, the health score's at 4 out of 9, which isn't the best kind of metric in the world, but there's a couple of things here that do kind of worry me a little bit. Just a little bit. I would rather go off this one, by the way, just going to put a point out there, versus the bankruptcy. The bankruptcy one's a bit of a weird one because some of the data isn't there. But yeah, for me, I've removed Shell because it just makes sense. Now, the other one that I've removed is also Unilever. Now, Unilever is a pretty big company. It's a packager and producer, whatever, of everything, pretty much. If you're in the UK, you'll know that there's quite a lot that are attached to this brand. The problem is it's not doing very well in the short term. Let me kind of explain. So, again, it's the same situation where we've got a bit of a decrease in revenue. Quite a lot, actually, in terms of every single sector has been hit. Literally, it's like 3% there. You got 5% in the home care, 7% in that, and whatever that, 7% in home care, 6% in personal care, beauty down 1%. Oh, yeah, that is a bit of an issue. The other issue is where it is in terms of sales growth. It's down quite a decent chunk, quite a lot actually. But another thing as well, which is kind of often overlooked, is the dividends are not great. The dividends was looking good, but then it kind of slowed off a little bit. And that's the one thing that kind of you'll see it when I go to my portfolio score, like what I'm looking for. This doesn't hit any of the metrics at all. And even when we're looking at this, the value, it's not very valuable. The quality, it's actually dropping quite a lot. It's got momentum in terms of stock price, which is fine. But if you want something long term, you don't always want momentum. You want something steady. You want a quality company that's physically going to do well. And look at the valuations of it. Like the valuations are like in the red for everything. It doesn't fulfill as a really good quality company that's going to keep churning the revenue. If this was churning the revenue and doing very, very, very well, And you got to remember tariffs. This is an international company as well. It could have a lot of issues going forward. But what I will say, it isn't terrible. I've just replaced it with something a lot better, and you'll probably see why. And the final one, this was not based off like fully what's on the screen here. It's a quality stock. It's a dividend compounder. It's fine. But the valuation of it was just too high. Momentum's taken an absolute battering. But more often than not, the dividends are quite weak, right? In terms of, yeah, it's a growing dividend. It is consistently growing, as you can see here. It's hitting all the metrics, but it is a very small yield. So it was 2% of my portfolio. Might as well just reduce it and just remove it completely because it's not going to really change much. And I'd rather use that 2% elsewhere. However, what I will say is the revenue has obviously increased. You can see that here. It's not doing bad. It's not a bad company. But ultimately, for my own portfolio, I had too many stocks that were like dividend growers, low yield. And that was taking up a bit of the proportion side of it. And that has made a bit of a difference. So it's not terrible, but as you can imagine, momentum is a bit low. So what I've added and changed is something, two stocks that are somewhat very different. And you'll see why. But what they give us is stronger recent growth, better consistency, and they actually score miles better on the platform here for quality and overall dividends, right? Now, I want to showcase a couple of things that may kind of scare people. This is quite a steady company. It earns a lot of money. It's a small market cap, but it is actually quite a big industry thing if you're in the UK. Let me explain. So, when we talk about overall metrics and we look at all of these, now, overall, it looks a bit mental in terms of the cash is low, all that kind of stuff. And, you can see there's a couple of bit of things going, oh, well, hold on a minute. But the reality is, this is making a stupid amount of money. In terms of the health score, it's actually pretty good. As you can see, it's significantly improving. They have only just recently, as of like last year, started doing dividends, and that is going to potentially increase and increase and increase. But what is interesting here, for the last 26 weeks, it says here, a decrease of 1% in revenue, which is, yeah, it's all right. Net income has increased, though, by 16%. But it's kind of saying that the revenues reflect a decrease in demand for company products and services due to unfavorable market conditions. That's kind of fair. Now, net income reflects finance cost decrease of 44%, 1.8%. So basically what's happening is their financial costs have decreased by 44%. So realistically, a little bit of a change in the model. But there's a lot of favorable buyers here, which is good to see. Now, let me explain what this company does. Now, this is the largest UK's newspaper and magazine wholesaler, 55% of the share. Now, I know people are going to be like, oh my God, magazines and newspapers are so 2000 or 2010. But they also do a lot more than that. They don't just do, you'll see it in a minute, they don't just do newspapers. Now, they operate around the clock. This is huge. They do newspapers, they do recycling, they do pick and pack operations, they do everything that you can think of regarding a news outlet. Not to mention, you got 1,400 employees, 35 distribution centers, huge amount of revenue, loads of experience, and I can bet you bottom dollar you've probably been in a news agency like this in life if you're in the UK. So overall, you can see in the general gist of it, all of this is huge. That is massive, and it hasn't changed, and it probably won't change for a while neither. Decent amount of customers, decent amount of products, a load of deliveries, and yeah, recycled. So yeah, for a company that's quite small in market cap, it has a $1.1 billion revenue. And as I say, it is the bread and butter of the United Kingdom. Mentioned it in my previous video. You often see an old person or a middle-aged person with a newspaper coming from the shop with a pint of milk and a loaf of bread in their hand. That's just the reality. And the other one that I've added is Mitie, which you've probably heard of if you've been in and out of hospital or whatever. It's not perfect, I'll put it that way, but it's kind of like the backbone of the technology industry around the public and obviously the private sector. Now, in terms of revenue growth, it is off the chart. You can see in the financial years, these are all lovely. Everything looks great, pretty much. Dividend is also doing okay in terms of growth. It's decent dividend yield. It's got a really good cargo on it. I cannot see anything realistically wrong with this company. 14% up in revenue. It's boggling. It's boggling. And as I say, you've probably heard of it. But up at the top right hand screen here, 94 stock rank. good quality, good momentum, and in somewhat the valuable situation. Now, what is it? You've probably heard of it. The UK's leading facility management company. Basically, long story short, technology, cleaning, engineering, whatever it may be, security as well. So if you see hospitals, you probably see cleaners, you probably see the engineering side of it. You probably see the integrated management facilities as well. So you've probably seen the vans around, you've probably seen the people around. And as I say, right, there's a lot of customers. 3,000 customers, public and private sectors, 5.1 billion revenue. It's ridiculous. Ranked ninth on the inclusive top 50 employer list. So yeah, it seems like a freaking obvious pick, really. I don't know why I didn't pick it earlier. Now, I alluded to it before, we will go through my portfolio and what I am kind of qualifying my entire portfolio on. Now, this is my own custom kind of sheet. It's my own little investment list. As you can see, obviously ETF's not included on this. But the main thing around this is not the stock rank, not the quality rank, but the combination of these essentially, right? And we'll go through it because I want to kind of explain what this kind of metric is. So the QVGM rank is the weighted combination of the quality rank, the value rank, and the growth with momentum. So it's all four of the ranks in a computation. And the reason being, I want a quality stock that's not going to go bust. I want somewhat of value where it's not overvalued and it's not a crap entry. I want growth. Is it going to grow? Is the dividend going to grow? Is it going to be a growing, healthy company? And is there a bit of momentum? Momentum is as in the price. Is it actually doing something? Is it not going downwards like that? And that is the core element. I always said in my early videos, I want a quality company that will have a good dividend, that will somewhat grow a little bit, not have to be crazy, but also have momentum. So this is what we've got. Now, as you can see, some of them do scour a little bit low. I think the lowest is a London Stock Exchange, but realistically, a lot of them are quite high, and a lot of them are high flyers or super stocks or a bit of turnaround. Some of them are neutral. But when we talk about overall in terms of the bubble, we have quality and value, right? So some good products here up at the top end, most of them in the middle, none of them in the junk, right? Value and momentum. Quite a few of them are at the low ends, essentially with value because they're quite high in kind of price, but they could obviously rattle out a little bit. But the main one I'm looking for is quality and momentum. A quality stock with decent momentum, and most of them are in the green, which is important. But overall, at the top, a simulation of the portfolio, I have outperformed essentially with this portfolio the FTSE 100 quite a lot, which is good to see. And I like to think that my portfolio has a decent split. Yeah, there's quite a few in the financial market, which is fair enough, but there's enough here to kind of look at and go, well, you know what? It's not too bad. It could be a lot worse. And to kind of get a bit of a gist of why and what I'm looking for, of like how to start off with, you can look at super stocks, you can look in the United Kingdom or whatever country. I'm going to be doing a US version of this at some point as well. Start off with stock rank of 99. Try and find the top quality companies out there and then kind of filter through that way. Because let me just give you an example. Look at Sainsbury's, for example, right? An obvious company. Go to the stock report. It's got really strong momentum in price. It's got good value currently as well. Not to mention the quality is okay, but it could be a bit better. But you may well look at that and think, you know what? Might just take a punt on it. It's an obvious one, but who would you rather go with? Sainsbury's or other companies or other ones like it? It's not bad. It's not a terrible stock, but realistically, every single stock will have a purpose for you, and each different factor. It does have a low CAGR for dividend growth, which probably does put a lot of people off if you look for a good dividend company. But realistically, the reason being is because a lot of their dividends has actually stopped over the last couple of years due to obviously COVID and stuff like that and different reshaping in the company. But the reality is here is still not a bad stock. And as you can see here, their revenues have increased by 2%, which is quite a decent chunk. They've also increased 36% of net income, which is good to see. So yeah, you can kind of do a bit more research here, a lot more research. Now then, let's look at the scores on the doors, because obviously with doing some changes here, that has changed. The passive income has majorly changed, and it's now 4.18%, which is good. Obviously, removing Relx was a big factor in that, and obviously moving that 2% a bit higher up the food chain. But the reality is here, this is quite a stable portfolio now in terms of longevity and moving forward. And I am a lot happier with it due to the fact that the metrics are looking relatively good. Now, with this, yes, some of the goalposts have changed a little bit. The yield on cost is 4.27%, which is pretty decent. Smiths is obviously a big one. So I've got a mixture of low dividends with growth and high dividend yield with less growth, essentially. But the reality is here, I feel now it's a lot more balanced, and you'll see that. So if I go onto my dashboard, actually, bear with me. Yeah, dividend. Oh, sorry. There. That one with the dividends. They do have decent growth for the last 5 years, most of them. Now, the scores are not as good on this website versus the other website, but ultimately it's giving you a bit of an idea. Overall, my dividend growth is a decent chunk. It's 9.88%, so that's relatively healthy and obviously a good dividend yield. So it will make the performance of the portfolio look a lot better. Now, some of the information is not going to be perfect because obviously with Smiths, they've only been paying a dividend for like the last year. So that one's a bit of a red herring, a bit of doesn't really fit, but ultimately willing to gamble on it because I understand the industry, living right next to a newsagent and stuff like that. So it's looking relatively good. Overall, though, as I mentioned before in previous videos, the goal of like getting roughly £20,000 per year is about 11 years away, which is ridiculous. So I always said I want to be able to double my investment capital via the dividends while still putting 20 grand a year in. Continued with that, that will aim and hit that element essentially with this current score in roughly 11, 12 years' time, which is mental. But we are still looking relatively good, even with 13.22% returns over the average return on this portfolio with the reinvestment of dividends to hit roughly a million on a safe, kind of portfolio here. We're looking at 2042, which isn't bad. And that is still 17 years away, which kind of fits within that kind of round number. But obviously, the element with this is it'll depend on, essentially the obvious inflation. So if we're looking at in terms of safe portfolio here, which is essentially just give you a bit of an idea, a safe portfolio is roughly around 10% reinvested dividends, and current portfolio would be this performance. Obviously, it depends on what this is. If we're looking at a bit higher than that, it'll do it a lot quicker. It just depends on where we are, but obviously the inflation numbers are going to matter. It'll also depend on the UK. Will the UK slash the £20,000 capital limit? The obvious question is, why am I moving my portfolio around so much? I shouldn't be. It's all about getting set. It's all about having that dynamic approach and removing and bidding the underperformers and adding stronger, longer term ones that will fit my portfolio realistically. As much as Shell are a giant and Unilever and stuff like that, they're not really delivering on certain metrics that would kind of make you feel confident. I want to put more and more money into this because ultimately it may not reflect as well. The goal is to be stable, not to be into a volatile portfolio, not into be like in a portfolio that could like nuke 20% because of a really bad earning system. The reality is here, we need to keep it sustainable, and having that Stockopedia score system does keep you kind of level. As much as I have like a pool of like portfolio where a lot of it's growth and a lot of it's kind of momentum and obviously a lot of it's high yield, it's kind of a good mix with the ETFs in there. It will just help it overall. So yeah, as I invest more capital, it should get easier, it should grow more. And obviously, if we are still getting a 10% dividend growth over the course of that portfolio every single year, it will still compound along with the momentum, along with the value that is, hopefully achieved by that portfolio. So there we go, we're done. Let me know if you would buy any of these stocks that I mentioned or any what should be on my list. I know a lot of people do mention stuff like Game Workshop and but in my opinion, I think that's a bit over the hill now. I think the value is not there. Likewise, I had a comment about BAE Systems. I still own that, but ultimately I've owned it for a while. That value is really low because it has done so well. Doesn't mean it's a bad stock. It just means maybe you're not getting the best value out of it. Anyways, watch this video in terms of ETFs and what ETFs you should look for because I get asked a lot of questions on those. So yeah, I'll see you in the next one.